Well, good afternoon, everyone. Today is the first of the month, and as you see, my name is Glenn Thompson, and we're ready to begin. I just hit the record button, so if you miss any part or if you'd like to check it or re-listen, you can check. You can get a copy of the recording from Pacific Trading Academy. As you see, if you need to reach us, here's the contact information on the screen present, 800-339-8588, or you can access the website www.pacifictradingacademy.com. Once again, welcome. We're going to talk about market timing, theoretical components integral to market timing today. It's my area of research, and I place a lot of emphasis on that. Over the years, I've done a number of webinars on market timing, and it's certainly integral to some of the analysis that I do. So once again, welcome. If you have questions, write them in on the control panel area on the right side of your screen, and certainly if there's any interruption in the flow of the presentation, let me know, and I'll be happy to kind of hopefully fix it. I always start in a general sense because I don't know who's listening in. I have been trading for 34 years. I've been with Pacific Trading teaching since the beginning, since they started almost 16 years ago. And I always mention that because you never know who's out there in the audience, and we have a universe of different types excuse me, of traders and investors and market participants. We have long-term traders, we have short-term, we have options, we have securities, derivatives, combinations, hybrids, swaptions. There's infinite variations. Well, I won't say infinite, but there's a lot of different variation that separates and creates the liquidity that we call the markets. So in a broad sense, I think we all starting from more or less a similar vantage point with the incentive to want to be profitable and maximize our returns. The best I can say, broadly speaking, is that we have analysis which leads us and assists us and facilitates our efforts to locate good trades. That's number one, and that's what most of us spend most of our time working on. We have to get some advantage versus the traders that are our competitors in a sense, and that's we do so by the sum total of models and tools out there in the world. A lot of traders have frustration because they have not, they feel that once they've put together a model or a system or a methodology, they're still not able to realize whatever objectives financially they are looking for. And I believe to some extent it's not the complete explanation or reason why, but partially at least it's due to the idea that you also have to add, along with your models and methods and strategies and indicators and relationships you depend on to locate good trades, you've got to have good capital money management rules. How do you determine risk assessment and trade sizing and things like this? And last but not least is making sure that our emotional status is what it should be in response to the vast array of outcomes we can get and generate through the process or as a result of our trading and investing. That we're going to have ups and downs, so we have to make sure we have a proper response to the variable response that we're going to get from our trading. And all three of these things need to come together. I want to focus on a very specific item today, and that's market timing. Very few traders, in a nominal sense or as a percentage, utilize any type of market timing. Timing has to do with, or the whole point of market timing is to enable the practitioner to generate forecast in time. That is an indication as to when in the future we can expect a change in some feature of the market. A simplification of this would be to assume it's a trend reversal. And I always tell the people that I consult, usually in the bigger sense, we don't want to establish trends or firm up a trading decision or place orders and enter into the market solely on this, having timing as the sole component. But if it agrees with other factors, other pieces of information of other generic types, like your price analysis, you essentially are improving your odds. And trading is a probabilities business. This is the entire enterprise of investing in market operations is about probabilities and whatever information we're armed with tends in an optimal sense to maximize our chances, and that's what we want. So I think of excuse me, from a practical standpoint, I think of market timing as a different form of analysis. I like to jokingly refer to it as the neglected axis of market motion. Most of us spend most of our time focused on price. And I think in the last few months I've done seminars. That's the last time I did a webinar, I think, was on trend and the importance and the central place in importance and great importance I attach to the trend. It discount everything. That's the primary premise of the technical approach, that all information is contained implicitly in the price, and I truly believe it. A close second for me is, in terms of my tools that I depend on and use to locate good trades, is my timing. From a cause and effect standpoint, I'm always quick to tell people, and again, this is my personal view, this is not universally held. In fact, probably I would imagine more traders would not quite agree with what I'm about to say, and that is, I believe all price changes, all what we call price returns, up, down, of whatever size, however large, however small, at the end of the day are due to or are a immediate response to certain specific amounts of time elapsed. Then it's a correlated phenomena. I'm interested in correlation. What will a market do after a certain amount of time has elapsed versus what will it do if an alternate amount of time elapsed? And that's essentially honing in on what timing is about. If I have historical statistical indications as to that a market has moved in a certain way or responded in a certain way after certain frequent amounts of time have elapsed off the clock, I can exploit that for the future. I can project that out into the future, and along with my price analysis, improve my results. So that's the whole point. So let me show you some of the ways how I do that, and then I'll show you some results of that going forward here in today's presentation. All right. Timing should always take precedence over price. Well, that's my view. Again, a person that's not using timing would have a different view, and this is what makes markets. But this is I say this from the vantage point of cause and effect. So that's more or less a fundamental idea. Even though I think of myself as a technician, meaning first and foremost allowing that the price discounts all information, which I truly do, to the extent I want to acquire greater insight about why it is and that why it is that a market's doing whatever it's doing, when I focus more on certain amounts of elapsed time or time periods, as it were, often I'm able to get clarity as to why it is a market's, an explanation is for the particular type of price action and motion and trending I'm seeing. All right. W.D. Gann basically at very deep levels had understanding of that the key to markets is vibration. Whenever we're talking about vibration, we're talking about some type of phenomena of oscillation. In other words, it's not static. We're talking about a dynamic phenomena. And I agree with Gann. Gann I would cite as my, although we never, we're two different eras in a sense, or time periods of, I consider his works and the principles he uncovered and presented to be critical to my success. Vibration is, and so the idea of energy, when I look at a price chart, when I consider or evaluate and assess the state of a market, be it a stock, be it a commodity, be it a futures, be it a forex currency pair on any time frame, in any way and however I observe it. Typically, most of us look at price charts. I am essentially interpreting that history of that market's behavior as if it were a graph of energy. Okay, so I'm thinking of, and so energy vibrates. It doesn't stay static. It doesn't stay in one position. And so this was that central insight of people like Gann and others more recently, even through today. Vibration creates repetition, which sets in motion a phenomena that will tend to persist infinitely in a theoretical limit. All right. So I always, those of you who have been following my webinars for years may recall this the set of two slides, this current one and the next slide. So to illustrate the concept of the previous slide, vibration sets up a repetition which will lead to a repetitive phenomena as reflected in this slide. So let's imbue this slide with its meaning to make my point here is to, and ultimately I will tie this to analysis and how and why markets turn and how an effective timing, a set of effective time protocols can give a significant edge in forecasting in advance when a market's going to change or trend reverse or form a top or a bottom from a technical standpoint. So the sentence on the sentence on the next slide is true. So if I'm taking this sentence that this slide presents in a literal way, I absorb its meaning as best I'm able to the extent I can comprehend the English language. The sentence on the next slide is true. Well, let's find out. Let's see what the truth is that this slide currently is indicating is presenting a statement, and it's saying that whatever the sentence on the next slide is, it is true. Well, here's the next slide. I progress to the next slide. What does it say? The sentence on the previous slide is false. All right. Well, the previous slide just indicated that this slide's statement or content is true. And in turn, this sentence, or this slide rather, presents the notion that the previous slide is false. So it creates this oscillatory phenomena, back and forth, back and forth, back and forth. If you ascribe the meaning of each one of these separately, you create a morphing or a phenomena that is nonstop. If you were to take each slide and the content contained implicit in the slide to be literal. The sentence on the next slide is true, the sentence on the previous slide is false, and it creates this oscillatory behavior, back and forth, back and forth, back and forth. I am illustrating this. This is a kind of a, in one sense, it's an example of the phenomena that I believe in a very deep way represents market behavior, financial market behavior. This is just an alternate kind of narrative example or metaphor for the type of price or underlying causative agent responsible for whenever if you're looking at a price chart as a 5-minute chart of Apple stock, or if you're looking at a weekly chart of crude oil, etc. From anything, if you're looking at prices of flowers, tulip flowers, any asset that can be that's fungible, that can be bought, sold, exchanged, etc., where there's money involved. Money is pure energy. And so money has this, and energy has a phenomenon of oscillation. It is not a static entity, and it by definition is in motion constantly. And what creates often, there are various triggers and catalysts in our universe that essentially create this oscillation, and I just provided, by virtue of these two slides, a constancy. Once a trigger or a catalyst has been presented to a system, it can create this oscillation which sets up a repetitive persistency of phenomena. All right, so I'll move on. Energy, the need for survival versus my cup runneth over. Well, what do I mean by that? Just trying to make a point here. All objects absorb and reflect energy. Well, that's just a basic physical law or principle, or it's a basic truth of the world we live in. The way we learn anything about anything is essentially, and I don't want to get too far off my topic here, but it's true that we learn. If you want to learn or understand something about anything, so as traders, we want to learn about the market, because to the extent I understand the market, where it is at any given point in time space. So what do I mean by time space? Price-time relationship. We normally look at a price chart, and a price chart of a stock or a commodity is merely a plot of its price and how that price evolves or changes over time. That's all it is. It's a time price plot. Well, we look at and study these charts, the idea being if I understand its current position, I am able, recognizing and applying the principles of the world, I understand that if it's a system that's dynamic and has moved in the past, it will tend to move in the future. And if I understand some of the guiding principles that direct its trajectory out into the future, I'm better able to generate a forecast or a viewpoint as to how I might expect that system, that entity, that financial market to move. If I generate and derive a forecast, I can correspondingly, as my next analytical step, derive a strategy to take advantage. I think the stock's trading at 50. I think it's going to go to 150. Well, what do I have in my cadre of tools that will enable me to profit from such? All right, let's go back to what I'm talking at the underlying motivating factor responsible for all motion. All objects absorb and reflect energy. And that's so we have the electromagnetic spectrum, the spectrum, various wavelengths. The smaller an object is, the higher the frequency of energy that it tends to be more receptive to absorbing. The lower frequency type energy tends to be reflected from smaller objects, and vice versa. Objects that are very large tend to be more readily able, based on their structure, to absorb and resonate with lower frequency energy. Smaller objects tend to, based on their size, their magnitude of structure, it tends to bit more easily absorb higher frequency energy. Well, when you anything that you observe and come to understand about an object or a system, the way that you understand it is because you are seeing that portion of the energy which, when coming into contact with the thing you're attempting to understand, is reflected to you. And some component of your sensory apparatus, be it your visual apparatus, be it your auditory apparatus, your tactile, all of our 5 senses as human beings pick up on energy. But let's think about that. We're only able to see, hear, touch, smell, perceive energy that has been reflected. We are not able to pick up and understand and conceive or perceive or receive any energy that has been absorbed by something external to us. When I look at an apple, here's the classic example. If I look at an apple, I perceive its color, let's say, to be whatever it is. If it's a red apple, it's red. Well, the reason I think of it as red is because that's a word in our language that we have assigned to a particular frequency of energy. And to be particular, it is that frequency of energy that has been reflected off of an object we call it and think of as an apple. The particular frequencies that were absorbed, we know nothing about. We're only aware of and have knowledge of and understanding about those particular frequencies or wavelengths. They are two. The word frequency and wavelength are inversely. They characterize and define the same underlying phenomena in 2 opposite ways. But what we perceive is some component of the electromagnetic spectrum, that curve of energy in the universe that has been bounced off or reflected off of the object of our interest. So when you look at a financial market on a price chart, an indirect way to bounce energy, just so I can bring it back to the topic at hand, when you apply an oscillator, let's say, or if you overlay a moving average to your price chart, in a more sophisticated way, you essentially are bouncing energy off that chart of Apple, that stock chart of Apple, or that chart of crude oil, or that chart of the U.S. bond treasury market, or whatever market or system you're attempting to gain understanding about. In an indirect sense, by merely applying or superimposing a 50 period or a 200 period moving average to a price chart, is a way, by virtue of the interaction that occurs thereafter, of bouncing energy off of that. And based on the energy, that some of that energy will be absorbed by that market, that chart of that market indirectly, but some of it, some particular frequency will be bounce off of it or reflected, and that which is reflected is you're now privy to, and it tells you something. You can infer something about the market, and to the extent you get that is the extent to which you're then able to make projections and conjectures and forecast about the future state of that object. Okay, every object has its particular frequency at which it best takes in energy, as well as those frequencies that are reflected. That's what I was just elaborating on. In this respect, financial markets are the same as any other object. At frequencies specific to different markets, a market will resonate with certain energy impacting it. Should a market receive too much energy, its structure will explode. This is the phenomena that ends trends. Okay, for all of you technicians within the sound of my voice, whenever you look at a price chart and we refer to tops and bottoms, well, from the perspective of an econometric view, you would call a top an area of excess traders supply. We want to sell. We have a selling pressure. If you have a bottom, from an econometrics vantage point or perspective, you might call that an area on the price range of possible levels at which that entity can trade, a level of excess demand, supply and demand, if you're thinking of it from an economic viewpoint. If we're thinking of it as a technical viewpoint, we refer to it as top and bottom, or region of support or resistance. If you're thinking of it from a systems vantage point, more deeply, from where we're at the level of energy, as a deeper, more, or a seminal beginning point of why the phenomena begins to occur or is occurring on whatever level you choose to think of it and define and characterize the narrative, it's energy. And when a top or a bottom occurs, it's because the system's prior motion has come to an end. Well, why is this so? Think of the old, if those of you, depending on how old you are, may recall the old commercials on television about a recording tape. Is it live or is it Memorex? It's the same phenomenon. When you have a system, let's say, or a glass, you have a very delicate wine glass, let's say, and you have in the same vicinity of that glass an emitter of high frequency energy, let's say an opera singer. Well, once the pitch increases so to a higher and higher frequency of auditory energy, it can, if it resonates or if it's of the same structure of the glass, let's say, if it's resonating, that's going to allow some of that energy into the structure of that system. Well, if it keeps coming in, it's going to get to its filling point, its tipping point. So thus my cup runneth over. You fill a container past its brink, past the level of volume to which it can contain, it's got to go somewhere. Well, if you keep pumping in, if you, in the battle of pressures, if you keep pumping gas in to a vehicle and you fill it past its capacity, it's going to overflow. Essentially, that's the phenomena responsible for a market top or a market bottom. When you see on a price chart, or however you perceive a trend which is in motion, the reason the trend stops, excuse me, is because that trend at some point acquires so much energy, it can no longer, the energy has to go somewhere, and it has to break away or out of the confines within which it is held. Think of a market as a container of energy. If it fills up with so much energy, or if it fills with an amount of energy greater than the capacity of that containing vehicle, it's got to go somewhere. Well, if there's no more volume available, it will break out, and in the process of breaking out, it destroys. It is a destructive phenomena which is responsible for the creation of a market top or a market bottom. So purely at a very deep level is an energetic phenomenon. Well, let's go be a little more specific here. All right. If you think of, there's certain frequencies of energy that create destruction and create construction, if you will. Let's think of a circle. So there's reasons why, I'm just not being arbitrary, but energy generation in a wheel. Need to divide the circle into equal parts. Harmonic table, aspect name, division of circle. Let's just think of a normal circle of 360 degrees. It turns out if you, I'm just realizing I should have, let me go back, let me progress to the next slide actually. I should have presented. This is a circle. Here's what I want to show you. Just imagine a circle. Let's look at, this is going to create standing waves, which will have the effect of supporting the persistency of the phenomenon, which ironically, even though it's constructive, it brings about on the level of a financial market an end to a trend. And so in a sense, I would refer to that as destructive. All right, but the reason a trend stops and a new one of a different type, let's say, begins, is because of the phenomena depicted on the left side of this slide. You have what's called a standing wave. If I'm sitting on the circumference of a circle, theoretically speaking, to illustrate why one trend ends and another one begins, here's the underlying energetic reason why. If I'm, say, at a position on a circle at 0 degrees or due east, whatever you want to call it, and I were to bounce a projectile from my point exactly 90 degrees to due north, the angle of incidence always equals the angle of outgo. Angle of income or incoming projectile is equal to. In other words, the angle, if you were to draw a horizontal line, the angle to the horizontal on approach is always angle equal to the angle of leaving. This angle here to the horizontal is exactly equal. That's a universal principle. So it turns out you can see some of the energy would peter out, but it reinforces itself if you're at exactly 90 degrees. Why? I don't know, but I do know that that specific angle has the net impact because of these principles, that if you were to bounce this projectile internally within the circumference of that circle, it would be self-sustaining, creating a standing wave. It would keep going. And it is, as such, we think of it as constructive. Well, it allows for more and more energy to fill up a system. If at each one of these points around the circumference of the circle, which happen to be spaced 90 degrees apart, are allowing for this sustenance of energy, if I'm sitting there, I am more likely to take in more energy. If I'm at any one of the four corners that define a square relationship inscribed within a circle, I am going to be the recipient of more energy versus, look at the picture on the right side of the frame here. If I just adjust my beginning point, let's say 10 degrees, so I'm at 80 degrees away, instead of being 90 degrees where I would be between 0 degrees and up at 90 degrees if we're going counterclockwise around a circle, let's say. Notice that, again, in accordance with this principle, the angle at which it arrives at a destination is equal to the angle at which it leaves that same destination. It does not, only certain angles have the phenomena of ending up at exactly the same starting point as they make their way around the circle. If you adjust it to, let's say, 80 degrees of separation, it does not have this wave sustenance capacity or property. It tends to fall apart because it's not reinforcing itself. Okay, well, let's back up. It turns out, I should have again had this slide after the previous slide, but no matter. What's important is that certain specific degrees or amounts of separation, if we were to mark off the circumference of a circle, what are known as harmonics of the circle, divisions of separation if we divide a circle into two, if we consider again a 360-degree circle, if you divide that into two, it's 180 degrees, okay? And as such, that is known as if you were to divide a circle, it's known into two parts, equal parts, it's known as the second harmonic. Similarly, if you were to divide a circle into three equal parts, each one being 120 degrees, that's your third harmonic. If you were to divide, vis-a-vis the last slide we just looked at, the circle into four equal parts of 90 degrees of equal, that's another important harmonic, the square. And the sextile, 6-degree equal parts, all 60 degrees, 6 times 60 being 360. It turns out there are others, but these 5 specific equal divisions of a circle all have the property that this phenomena over here, they all sustain the energy traverse around and internal to the circle. And as such, they allow for greater and greater amounts of energy to be absorbed by the receiver. So if you're at any one of these positions, this reflects just one of the important harmonics that have the constructive property or sustaining property of creating and sustaining what we call a standing wave, let's say, as observed within a circle. There are ramifications for this within harmony and music. This is why harmony is a big part of music. Well, the harmony of the financial markets is based on the similar, or exactly the same. It's not similar, it's the same underlying physical phenomena. It's an energetic phenomena. Okay, so if you are, let's say, using this fourth harmonic of the circle, where every if you were to divide a 360-degree circle into 4 equal parts, each portion or quadrant being 90 degrees, it turns out that by bouncing off of those 4 points, if you're at any one of those receiving stations or points, if you will, you're going to be the receiver of a lot of energy. So much so, if it continues for up to a certain threshold, the energy will overwhelm the system, the receiving object, and at some point it will be such that it will create ironically a destruction of that receiving endpoint. And this is the exact phenomena that creates a market turn. Okay, that's just an energetic explanation if we're interested in understanding the theory of why a market forms a top or a bottom. All right, any questions so far with that? I'm going to relate this to the real world as we move on. All right, so far so good. All right, let's move on. It turns out, let me just quickly, so I can make a little more sense, this is when if there are no divisions of a circle. It's what's known as the first harmonic of the circle, 0 degrees of separation. And so this has catalytic properties. There's something, there's two, the conjunction being the first most important, and the second most important being what's called a second harmonic, or the opposition fraction or harmonic of a circle. 0 and 180 degrees have, in addition to what I've just indicated, allowing for bringing about rather the sustenance of long-standing energetic frequencies being allowed to be absorbed into the system within which the energy is flowing. There are some additional properties that these two harmonics of a circle, let's say, have above and beyond some of the others that are also constructive. And that is, they serve as catalysts and triggers, very potent because of certain again, natural phenomena. So this is what we call conjunction power. Conjunctions in particular, when two things from the Latin coming together. So let's imagine, I just want to illustrate this, the theory of why market timing works. If this region, if you've got two kind of prongs or spokes or lines here, let's say one is stationary, one is revolving. So the line number 1 is stationary in space, and it's at a pivot point. We've got a little thumbnail in here, or a pin in here holding them, but allowing the rotation of one of them. So let's say 2 is rotating clockwise. You've got a region marked off here as indicated of positive polarity, and then outside you've got negative polarity. Understand prima facie that positive and negative charges repel each other. So let's say there is a single positive charge in this region of positive polarity on the right side of the picture, and then this is the region of negative polarity, and there's a loose negative charge floating around in there somewhere. Let's just say, to set up their thought experiment, if this spoke or this line number 2 is rotating clockwise as it gets closer and closer, because of what I just said, we got to understand positive and negative charges repel each other. Or excuse me, like charges repel, opposite charges attract. So if I've got this region of positive polarity and I've got a free charge, as spoke number 2 or line number 2 gets closer and closer, the distance between each of these, the stationary positive charges, this realm of positive polarity, and this free positive charge floating around in space, let's say, it becomes less and less. And so the frequency of this free charge is being repulsed or deflected or pushed away from its like. Again, like charges repel each other, opposite charges attract. So as the distance of this region decreases, we're running out of space. And so the rate of frequency, this ties into the 2 slides that I was using to show the vibratory effect. The next slide, if you go back and recall, whatever the next slide says is a statement of truth. So we move, that forces us or compels us or suggests implies that we should move to the next slide. We get to the next slide, it says, the previous slides, whatever it says, is false. And that in turn creates this oscillation. Well, similar real-world phenomenon. if we have this on a pin and it's rotating, decreasing, however fast it is, however slow the velocity of rotation of line number 2. As it rotates and approaches ever more closely to line number 1, the space of the positive region is decreasing, and the frequency of repulsion is increasing. The space is decreasing, the frequency of oscillation is increasing because there's less and less space, so it's going to bounce back and forth more and more frequently. All right. At some point in the limit, when this spoke, let's say, is perfectly aligned, there is zero space. It's similar to the energy. If you if you're pouring water or a fluid or some liquid or any liquid into a container, at some point, given the size of the container, it will, if you keep the flow constant, it will overflow the volume. And if, let's say, there was no open portion of the container, and but it was closed, and you put a pump or a nozzle or a tip that poured, or let's say a funnel into the container, but there was no escape mechanism. The volume the fluid that you're pumping in could not escape. There's one thing left for it to do. The pressure with if your pressure of pumping in the volume to the container is continually of a certain amount and continually constant, at some point when you continue to push fluid into a finite-sized container, if there's no mechanism to escape, there's no opening, the pressure will build to the point where it will offset or be greater than the strength of the molecular structure of the container. What results? A destruction. It will burst or explode out of the container. The exact same phenomenon for a price turn on a price chart, or the turn or the change in price, however you want to think of it, in the real world of any fungible asset, a stock, a bond, a commodity, a tulip in Holland with tulip mania, or whatever asset we can talk about. And this is ultimately, at the end of the day, due to the same phenomenon. Well, what happens in this, what we call conjunction? When this rotating line or spoke or whatever you want to think of it is perfectly superimposed for maybe an instant in time, there is zero space. This charge has no place to go but to cut across into a different region, because it's infinitely being repelled by the like charge. So it's got to seek out, and it crosses through and creates an oscillation of an infinite current of positive charge seeking out the opposite, its complement. That's the phenomena that's responsible. Okay. And you end up down here. This is, if I could, in a more dynamic way, in a film, show the static continuum of degrees of closeness. Ultimately, the region of polarity shifts completely. But in the process, as it gets closer and closer, the oscillation of this positive charge increases. The higher the frequency, the greater the energy. And once at the point of zero space, it's got to go somewhere, because it's no space for it within which for it to reside. Where must it go? In the limit. It goes at an infinite current across to the other region, and the polarity of the region shifts completely. Well, this is when you have systems. There are certain specific cycles that create this phenomena, which tend to be very powerful, which serve as cues and keys and to indicate when I expect often, or when you can expect, a market will change or shift its regime of behavior. Okay, so this is just some of the underlying theory. I'm going to add, this is what I refer to as a conjunction resonator. This is I'm combining the property of conjunctions, this energetic phenomena, on a circle. Imagine a circle 360 degrees. This is one line kind of going south from this peak here. Let's imagine that stationary, and this is coming down. Same continuum of the previous slide. All right, now, if this gets closer and closer, again, at some point that current will cross through this region. If this were positive charges, as it gets narrower and narrower, less and less space, the charge must go somewhere. At some point, when it's superimposed, when there's zero space, that charge will move with an infinite frequency out to the circumference, to the boundary of the phenomena that's containing it, which is, in this case, is the circumference of the circle. All right. Now, at that point, it's moving with the frequency will be equal to the radius of the circle. All right. So and some of the energy at that particular frequency, again, the wavelength is equal to the radius of the circle. So the larger the circle, the larger the wavelength, the smaller the circle, etc. But the point I want to make is, as the energy reaches the circumference, some will go one direction, some energy will go the other direction around the circle. It turns out that as it travels along the circumference, it will have traveled a distance equal to 3 radius, 3 times the radius, which is where, that's what I've marked this point right here. You see, as it travels along the circle, it will have traveled 3 wavelengths, which is, and at that point, it will have, having traveled 3 times the radius, it will have been 15 degrees from the point of, let's say, where this conjunction occurred. Well, the reason I mention this is, if you think about the circumference of a circle, if you remember, and again, this is all junior high or high school or geometry. Remember, the circumference of a circle, or half, is 2 pi r. 3.14 is the number pi, if you remember that important ratio. Well, if 2 pi r indicates precisely the length of a circumference of a circle, pi r is just 1/2 of that. Well, pi is the number 3.14. Well, again, as it turns out, after this energy, which is leaked out, has traveled a distance equal to 3 radii, it will be exactly 15 degrees from the 1/2 of the circumference of a circle. Well, 1/2 of the circumference of a circle is equal to 3.14 r. What's the difference? What's the difference? It's approximate, you know, if 15 degrees is my rounded version, but it actually, it's 3.14. The difference between, it's actually, I use 1/4. That's actually basically the difference. And so if you take the percentage, what's the harmonic difference here between 15 degrees? That's what it's going to get to, a point 3r, which is this spacing here. And if you take the difference, as I've indicated here, as a fraction, it's going to be 4.5, or basically 4.5%. And then if you take 4.5% of the 360 degrees of a circle, it rounds out to about 16 degrees. Well, if you divide 16 degrees into 360, it doesn't go an even number of times. So that's why I use the 15 degrees. That's the closest even multiple, or devising, and that's why we get the 24 harmonics, or 24 even sections of a circle. That's why, by the way, we have 24 hours, or we mark off our day with 24 hours. That's why there are 24 time zones around the globe, each one of which is consists of 15 degrees of distance. That's not coincidence. It comes from the harmonics of the circle. And harmonics of the 24, it turns out that most phenomena in our day-to-day existence and in our world on Earth ultimately are measured in accordance with this 24th harmonic. And what's the significance of the 24th harmonic? Well, it's where it turns out that at that having traveled 3 radius, a distance around the circumference equal to 3 radii, it stops at the 15-degree point. So 15 degrees is an important, for whatever reason, it is very receptive. That fraction of a 360-degree circle happens to resonate, as the terminology we typically use, with the energy that was traveling around it. And to the extent it is resonance, what that means or translates in the real world, it is receptive. It allows the energy to come in. Well, that always creates in a sense, if we think about it, depending on how you think of it, an opportunity for a lot of inflow of energy. But in the limit, when you have so much energy coming in, it can create, ironically, the opposite phenomena. When it passes the amount that the container can hold, then of course, or a future phenomena is to bring about a destruction of the container. It has to go somewhere if you have exceeded the limit of capacity of containment. And so that's why we mark off our days with 24 hours. Half a day is half of that 24th harmonic, which is 12 hours, etc. This is why these numbers are important. Many phenomena in the natural world are a harmonic of the 24th harmonic, specifically 6, the hexagonal, creating a logarithmic spiral. Many phenomena, you have 6 components to the many fruits, apples. If you cut an apple, you'll see internally the 6 components. Stages of growth and development in all manner of biological life. Very often, a snowflake consists of 6 parts. Crystals, very often you see the hexagonal structure internally. And it's not by random accident. Nature has found that a very efficient intake and growth harmonic structure is based on this hexagonal structure, which in turn arise from the 24th harmonic. And this is why, and so to the extent a financial market, be it a stock, you name it, is, or to some extent at least, reflects broader human activity, it's not totally unexpected that I'm going to see some of these important harmonics. Ultimately, at the end of the day, fractional parts of the circle, the 24th being the starting harmonic. This is why we have 24 different time periods around the globe, each one of which is 15 degrees in territory covered, marking off the entire equator, or the if we were to circumnavigate our planet. We've separated it into 24 parts, creating the 24 separate time zones that we indicate and typically refer to. All right. Each one being 15 degrees in magnitude or extent. All right. Steps to determine cycle endpoints. Any questions at this point? I know this is all theoretical, folks. Make sure you guys, I'm not seeing anything, so hopefully you're with me. I'm going to relate this to the charts in a second. So, all right. Let's see, questions. All right. No questions. All right. Hopefully you're still with me. What do I do specifically? Well, I'm going to take the theoretical underlying energetic considerations that I've just mentioned and show you how, in a very basic way, I apply it. It may be, if it's new to you, and I use planetary cyclical relationships known as aspects. That's just one way to do it, but it's very, there's nothing mysterious. It is what it is. Steps to determine cycle endpoints. Locate high or low day. So you look at a price chart. Procedurally, you go to your chart. And by the way, the procedures I'm going to elaborate on now have universal application if I'm looking at stocks, bonds, you name it, or and I can apply it to any time frame. So whether you're a well, there are, say, modifications that would be necessary, let's say, if you're hyper-frequency day trading or intraday trading sometimes, because we're down in regions where the energy doesn't even have sufficient time to sum together to create the cyclical phenomena that I'm referring to, unless it does. But it's more, where you are when you drop down below certain windows of time within Brownian motion or white noise, and it is clearly more random. But even in those cases, you still, theoretically, you see the underlying energetic phenomena that I'm referring to now. But in principle, the principles will apply. If not, then with certain adjustments, it will still apply, and you can generate valid, reliable time targets. Okay, so what's the first step? You look at the history of the market as observed on a price chart. You locate highs and lows, or tops and bottoms, as we all know how to identify them. You, having located on the historical chart a top or a bottom, you want to see the energetic profile for that point in time when what was at play energy-wise that created and facilitated that top or bottom. On the high or low day, observe the aspects that the fast planets form with the slow. Wait a minute, let me stop right there. I just took it off planet. I took it off of terra firma. What do you mean? What do I mean when I say fast planets? Go back to, just let me help you if you're not with me. Let's think of the circle here, and let's think of the circle of 360 degrees, a very basic, rough, gross model of our solar system. Now I'm oversimplifying, but let's imagine the sun at the center, what's referred to as heliocentrism, and the planets are revolving around them. We have the same energetic phenomenon, but I'm going to use a planetary or celestial cast, if you will. So, nothing different. It turns out that the planets that are closer to the sun in the way our solar system is actually set up, you've got Mercury, Venus, Mars moving out from the sun, and the moon is actually considered the ones that are in the actual layout of our solar system. If you were to think of the sun being the central point of a circle, and then various planets, Mercury, Venus, Mars, and the third planet from the sun being the one we reside on, Earth. After that, or Earth and then Mars, I forgot, and then what is it? Saturn, Uranus, Neptune, Uranus, or yeah, on out, Pluto. Those are the slower moving planets. The ones further and further away from the sun, the ones closer and closer, they are moving at faster velocities. The more distant planets, as you go further and further away, are moving more slowly. So that's what I mean by that. But let's think of those in their orbits or revolutions around the central point, the sun, as the same idea as what I was referring to in the previous slide. If you were sitting on on some portion of the circumference of a circle and were to bounce a projectile, say from due east to due north, a 90-degree point or amount of separation. And imagine the energy dynamics, but in this case, instead of you or me or some little entity sitting on the circumference of some hypothetical modular circle, let's imagine our solar system. When the fast planets recreate aspects with the slow, that correlates with cycle endpoints. What do I mean by that? It's very simple. Let's imagine where Mercury, as it revolves, I'll just pick one, Mercury revolving around the sun. It's a faster moving entity. If it happens to be in its angular relationship while it's revolving, let's say 90 degrees of separation, think longitudinally. Let's just think if you have the planet, a body, let's call it Mercury. It's a very fast, or relatively faster moving object. It's going, and as it revolves around the center point of the circle, or the solar system, as it actually does in the real universe, let's say, or in our solar system, at some point, at varying points in time, let's just say, it will be certain amounts of degrees of separation from a slower moving body. Let's say Neptune. Neptune moves relatively very, very slow with respect to the velocity of Mercury, but they're both going in circular orbits in our simplified way of thinking about it. Let's say at some point in the respective orbits of both of those entities, they are 90 degrees apart. Well, that creates that might tend to be a phenomena that correlates with a market top or a bottom. Forgetting for the moment why it's so. That would take another 20 years for us to go through, or 20 minutes. I could get very simple, but I don't want to get into that. Let's just say we see every time Mercury and Neptune are 90 degrees separation, Apple Computer forms a top or a bottom. If we saw that the incidence of connection or correlation between Mercury and Neptune being 90 degrees apart in their respective orbits, and every time that was present, let's just say 87% of the time Apple formed a top, that might be something you want to pay attention to. And if we saw that occurring in the past, then if I have a mechanism or a means of inquiry that would tell me when the next time Mercury and Neptune will be 90 degrees of separation in their respective orbits, I have a mechanism by which I can project when Apple Computer will form another top. Would you place an order on that? Would you put your money on the line on that? I don't know. What I do know is I understand numerical statistics and patterns and correlations. And if I have at that time other factors, let's say from the vertical axis, price dynamics, that similarly point to a similar phenomena, a topping out of the price in Apple, I am essentially creating strength or adding strength to my probabilistic argument as to why I should go short Apple stock, or vice versa, you see. So procedurally, what do? You locate an important terminal point in a chart of the markets you're tracking. You find the energetic or planetary signature for that point in time. And then you project or locate the next time that will occur. When the fast planets recreate aspects with the slow, that correlates with cycle endpoints. That tells you when the same terminal point, top or bottom, will form or should form again. And so procedurally, now this is a general basic vanilla application. There are countless variations on this, but this is the starting point. This is the principal idea by which one can, in one way, there are other ways, but this is one way by which I'm able to know in advance with amazing accuracy, whatever, 80% and up, reliable. That's pretty good. And then this is just the timing component of the underlying analysis that I want to reflect on. All right. So there's an offshoot of this where I apply what I call harmonics of 90, and there's a time period analysis. All of these two, the harmonics of 90 projection, and where I look for convergences and I apply time period projection and look for additional convergences, are doable and applicable and occur because of the underlying energy dynamics due to the harmonics of a 360-degree circle. You see, so they all come from that. This is an example. This is an old chart of where I'm going to show you how I do this. This was a top on August. This is the stock market. This is back years ago. It doesn't matter because the phenomena repeats. One thing about time cyclical analysis, it is very deep. I often get asked the question from traders and investors that I consult, Glenn, are the techniques that I used 10 years ago, 5 years ago, 20 years ago workable and viable and profitable in the markets of 2016 today? Some are, some aren't. Cyclical cycles tend to be very deeply embedded, and in spite of what I refer to as superficial changes of the market, that reflect the more vagaries and temperance of the day, whatever phenomena are at work at any given moment in time, wherever you are on the timeline, 2016, 2050, if we were in 1997, wherever you are, or if we're at 1967. Cyclical componentry typically is very, very deeply embedded and is the underlying seminal factor or factors responsible for what we see bubbling up on the surface when you look at a price chart, or if you consider however you interpret price action and change. So the quick answer is yeah, this as a component, this time period elapsed and the cycles that we track and utilize and think of to track that are as effective as they were 10 years ago, 20 years ago, 100 years ago, and I expect will be similarly effective 100 years henceforth as they are today. Yes. So here's a chart, S&P stock market. Here's a top. And so I'm doing what the preceding procedures on the previous slide indicated. If I identify a top on that day, my next step would have been to locate a cycle. What's a cycle? What was the planet, the fast planet position relative to a slow planet position on August 26th? There was one, I bet you, I know that created and allowed for a top to form the way it did. When I locate what that was, I then use a reference. We have software that does this, that references and tells me when the same exact signature will occur. When it does, I have now a means of projecting when the next turning point or top, let's say, I'm simplifying a little bit, but not to the point. I just primarily to convey the thrust of the idea. So whatever was at work cyclically from an angular energetic perspective, what was my small or fast planet, slow planet relationship back on August 26th? The next time I know that the similar or the same relationship exists will be set and establish my forecast as to when I can expect the same type of top phenomena to occur. Well, it turned out I transported that to the future to October 17. This was August 26. The next time I projected the similar or the same relationship or cycle to exist was on October 17th. So I have a time target, a time progressed forecast for that market, you see. So here is This is for those. This is just a practical tool known as an ephemeris wheel. This was the profile, August 26th. Back up to the previous slide. 826. I had an important top, so I thought. I selected it. What was the cycle? Well, this red line that I've marked off indicates the important one of the day. It was Venus was 180 degrees apart from Uranus, and that was in part responsible for the top that formed. Whether I understand why and how and so forth, who cares? Unless you do. I happen to care, but that's secondary and of importance. What is important is on the continuum of probabilities, when this faster moving entity is 180 degrees from this slow moving entity on the circumference of my circle, the stock market formed a top. And so when I found the next time, October 17, here's the same thing. Here's the next time we have the similar relationship. You see, we have another important, okay, previously it was what, 180 degrees angular separation. That's referred to as an aspect. The next time the two are in a similar relationship, they're 120 degrees, it was on this date. So I now have a mechanism of forecasting when the stock market's going to form a top, which it did. That's how, and the picture you're seeing that this slide conveys is merely a software app that graphically illustrates for me, and so I know exactly when the next time I can expect a similar occurrence in the market. Cycle progression, this is just another example, same thing. I had an important bottom here on September 7, and the next time, October 12th. Same setup. What was at work on September 7th between the fast-moving body, the Sun, and the slow-moving body, Jupiter? It was what we call a 60-degree separation known as a sextile. That's an important harmonic. Where does the 60 degrees come from? Remember that it's a fraction of the 24th harmonic. It turns out when these two entities were in that degree of angular separation, we had an extreme turning point. In this case, it was a bottom in the stock market. When is the next time this entity, the faster moving entity, as it revolves around the circle? For those of you who may be a little bit confused because you're saying, well, I thought the Sun was at the center. That's a technical issue. We are on what's called the geocentric plot. If we were doing everything I'm saying, for those of you who want a little more understanding of this, geocentrically, where would the Sun be from the vantage point of our view here on Earth? So I do most of the projections based on from a geocentric view. That's a detail for those of you who are interested. But be that as, forget that. The energy is what's most important. This is an important harmonic relationship between a fast-moving body, i.e. the Sun, and a slow-moving body, the Jupiter, as it revolves around a 360-degree orbit. And that's what we're talking about. Energetics that correlate with that create and allow for energy in the system in question, in this case the stock market, a stock index, let's say. When energy fills it to a point where it can no longer contain it, something must give. What gives? The type of behavior and motion and phenomena that was in place prior to the energy filling overflowing its boundary. It breaks one type of market behavior, ceases, allowing for the onset of a subsequent alternate type of behavior, i.e. a market top or bottom. That's the root cause of it. Okay, similarly, we had another situation, the fast-moving body, 90 degrees of separation between a slow-moving body, Jupiter. This is a symbol depicted by this red line. They are at 90 degrees of separation over here. This is the Sun. This is the glyph for Jupiter, or the symbol for Jupiter. I'm going to use terminology. Okay. All right. This is just another way that I apply. This is kind of a variation on the theme. And I have told and taught for years traders how to project turning points very simply. If you didn't want to use the software that the previous slides indicated, just look at your chart. Locate tops and bottoms. You don't have to know why or how, but locate historical tops and bottoms. From any of the tops and bottoms that you have located, arbitrarily or otherwise, however you come to, because immediately traders ask the question, how do you know which tops and bottoms to pick? I don't care. What I do understand is they will tend to the significance of the moment. Whenever a top or a bottom has formed historically on the history of the market's motion as depicted on your price chart, it will tend, the similar energy that created that top or bottom at some point historically will tend to export or transport into the future by specified amounts of time elapsed. What amounts are they? Well, there are many, but these are some of the most important. 45 periods of time, 90, 180, 270, 360. These are important. So very readily and simply by projecting forward by those amounts. If I'm a day trader, let's just say, the concept will scale, but I will not be talking or making my forecast or projections or transportations in terms of days. I would scale it to, say, hours or minutes or whatever, but it would be units of time. It turns out that these numbers depicted. There are others. 144 is another important number, but these are basic, and they represent the square, harmonic. That they are. Think of harmonics as certain specified locations of a phenomena that in the flow or evolution of that phenomena through time tend to be stopping points where a lot greater than normal amounts of energy can come in. By analogy, think if you're riding on the freeway or highway or road, you run out of gas, you wait. The energy or harmonic point is when you find, or up the road or up the way, your fill-in station. A filling station is analogous to those specified portions along the circumference of a circle that allow for the influx of greater than average amounts of energy. Versus the way our infrastructure in our world today is set up, you normally can't, in mid-travel on a highway or a freeway, just automatically fill up your tank. You must find there are certain locations where we find you have significantly increased the probability of filling your tank. You can't just on a continual basis, the way our world works today. You could, in theory, if we had technology and engineering to do it. Think about an airplane, an aircraft. They have military craft or any craft, let's say, they have tanker aircraft which can hook up a tube or a lumen or a mechanism of transfer to another aircraft and fill it while it's in mid-flight. So the theory and the technology does exist, but to get back to our analogy, there are specified stations, if you will, or portions of the orbit of the system that are more resonant to an influx of energy. These numbers depict that. So if I start with a point where there was one point of great energy influx and run out by these amounts of time, it will similarly project for me future points of energy influx where I can expect because of or as a result of the added amount of energy, a bursting of that system, meaning a cessation of one type of behavior and an onset of an altogether separate type of behavior, i.e., to make it simple, a market top or a market bottom. So that's what I do. That's one kind of a very simple way to do this. All right. This is just an example of that. I pick started dates by, these dates reflect starting tops and bottoms that through visual inspection, this daily S&P chart, I located. And this, I should have marked the column headings. This would be 45, 90, 180, 270, 360. And this generates a spreadsheet or a database, if you will, of future dates that I know can create and have an awareness of when I can expect on a continuum of odds I have a greater likelihood for a turning point or a top or a bottom to occur. Now, this is just the basic starting point. When I get the same dates or the same or nearly the same dates occurring more than a single time, I establish higher degrees of probability to dates that are what we call time clusters. But that's going into the detail. I just wanted to primarily, there's an energetic reason why this works when it does as well as it does. This is another variation on a theme where I incorporate Fibonacci ratios. Most traders, I often am asked, someone asked me yesterday, do I do Fibonacci analysis? And I said certainly. What typically, when people think of Fibonacci ratio analysis, they're talking from the vantage point of retracements and projections to get price targets. You should do all of that, I believe, if you believe in Fibonacci ratios and the proportionality that you see manifested in terms of price. But I also, I have, based on or as a consequence of my perceiving price and time to be equivalent, different phenomena of an underlying equivalent phenomena, I apply it on the horizontal axis. So I will often locate and discern and segregate out what I determine to be important periods of time elapsed, and I am able to extract important time periods by multiplying those time periods by certain important fib ratios. 0.618, 0.786 or 789, 1.27, 1.618, those are the important some of the important fib ratios. And I'm able to generate time targets using Fibonacci analysis, but as it pertains to temporal or the x or horizontal dimension similarly. Okay, the final wrapping up here, folks, these are just based on my timing. Again, some are simple, some are complicated or a little more involved, but essentially most, I would say 90% of the time relationships that you can utilize have their origin and their effect and are as efficacious as they are because of the underlying energetic. They allow for an influx of energy to come into the system, or rather I should say they indicate where and when, more precisely, if you're thinking along from the vantage point of time, they indicate when we can expect in the evolution of a system that's dynamic it to be more privy or resonant with a greater amount of energy. And the times at which the market, or any system for that matter, but if we're talking about, in this case, gold, I understand this was very important just for historical reference here. May 27 was a point that back in, I don't recall when I did the analysis, but I indicated way in advance that on May 27 the market would turn. Well, it actually came May 27. It was one day. I think it was a Friday. This was the Monday. This was the actual bottom. Do you think, just look at the subsequent price action, this yellow line represents my theoretical forecast where I had projected a turn in, or a trend reversal, let's keep it simple, in the price of gold on May 27. If I recall, when I put this slide together last night, that was a Friday. I was off by a day. It actually occurred on a Monday. So within and I might have generated this forecast weeks, if not months, in advance. So I have other time targets that I have generated that in the interim, but the next one, jumping to the future, well, it's upon us today. This is specific to gold. It happens that September 1st is today. I don't know why there's this separation here. I might have missed, but this line represents 9-1. It doesn't matter how I set the chart up. 9-1 is the important information. And that happens coincidentally or otherwise to be today. What is the implication? What does it tell me? It tells me to expect a change or a reversal in the price of gold on or about today, assuming, now, for historical, just to give you context and understanding, I was off by a day in the previous forecast. But this is why, from a practical standpoint, I'm suggesting, or the caveat of application in the real world is, I am going to combine this with all of my price analysis. If I've got other factors that would similarly indicate I would expect the price of gold to stop declining and start rising, to that extent I can acquire such information that would reinforce and corroborate with my timing information. I will correspondingly have greater confidence that I should further, more strongly entertain ideas that would be consistent with my expectations of what the time projection indicates. Further, I've already projected out a subsequent time point specific to gold, November 5, based on cycles and time procedures, all having an underlying starting theoretical foundation based on the harmonics of energy in a circle. Very important, very helpful, very profitable. This is a trade that I am in currently, and to a large extent the genesis, the establishing of the position was due to a consideration of a projection in oil. This is the October oil contract. Some at whatever point, weeks, months, I don't recall when I did the analysis, but I projected a turn in a turning point, a trend reversal in oil. If you can see this date, August 18. I don't know if you can see it. It didn't see in the slide. It looked better when I was putting this program together last night. But my projected, this vertical line, this date is the date of August 18. Well, it actually, I was early by 1 day, because the top here, if you can see that, is 19, August 19. So I had an indication at some point way in advance of August 18 to expect a turning point. One of the points that comes up is that if I had done it way back in May or June, I don't know, I don't recall when I actually generated this time point of August 18. But the date itself, the time projection by itself, in this case, did not tell me whether it would be a top or a bottom. What it told me was to expect a trend reversal to occur on or about August 18. We see in retrospect what happened. It occurred 1 day later, the top. So, I always tell traders that I'm instructing this technique, initially you begin to determine or forecast in advance whether the turn that affects, if the correlation plays out and manifests and occurs in the real world, you know, what type? Is it going to be a top or bottom? Well, based on the preceding trend. If the market's trending up, as you get more and more closer to the projected date, you're going to reasonably assume it's a top, and vice versa. So this was a top, and so we went short. That was, I guess, on a Sunday or a Monday, I can't recall, but we went short last Monday on this long black candle. We are short from 47.42. Now, for example, just in the real world, that was a primary pillar of theoretical information based on pure time analysis, the underlying energetics of which the previous slides depicted. Now, would I have gone short solely on that? I don't know. But to the extent, I'm not suggesting if you're getting started you should. I am suggesting it merely indicates a complementary, you have some indication as to expect a reversal on or about the 18th of August, which it came in this case, a week ago, or whenever that was, on the 19th. So we were 1 day early. I ended up selling on the Monday, whenever that Monday was. Let me look at the calendar. I don't recall. On last Monday, I went short. Okay, here it is. I remember this is the 18th. This was the 22nd, so this was the weekend. I went short last Monday. This on the 22nd. That's what this long black candle represents. It was last Monday, the 22nd, and we get short oil from 47.42. This is where we ended up with last night at about, I don't know what time it was in the evening yesterday. Now, also, these numbers here, if you can see this 61.8, this it's obscure, but that's your 78.6 Fibonacci. These are Fibonacci ratios. What I also noticed is from this higher top back here to this bottom, the amount of retracement correlated with what we call a Gartley. So I had two very, very, very different pieces of information, in spite of their differences, converging. I had a Gartley, which correlates very strongly, 75% probability once the market had finished this decline, retraced into this region of between 61.8% and 78.6%. And so that was another factor that would have encouraged me to consider exploiting the short side of motion. The fact that the market moved into this region of degree of important correlated Fibonacci reversal at a time that I had projected to be an indication for a turning point. Two very different reasons why to consider embracing the short side of the market, and you can see where we are as of last night in this trade we're still in. This is today. This is the current trade as of a few minutes before I got on board with you in today's presentation. So we're short from 47.42 to a large extent. The origin and the establishing and the consideration of this entry at 47.42, and we're trading, this is at 43.09. So from 47.42 to 43.09, we're up over $4 per position. That's over $4,000 of return per position in this market, based to a large extent on the awareness and understanding and projection of a future time point. This is similar for the current stock market. This is the S&P, the September contract, historical, and some future. I have a lot more. I just showed or presented for the slide some more recent projections. Perfect projection. They won't always be perfect. We had projected months ago at the beginning of the year, if not, well, I don't know, I don't recall, but June 28. Perfect. This is the Brexit scenario that we recently, everyone's interested in and have thought about, and created volatility shockwaves all over the globe. But be that as it may, we are armed with more understanding, and I call these rotational these are guideposts in terms of time. This ushers me, by establishing and projecting these time targets for any market that you choose to, I am able to kind of have a temporal concierge, if you will, that guides me in my tour of the market's motion forward through time in a figurative sense. But this was a perfect forecast. The market formed a bottom on June 28. I had known about that. I did not know that it was going to be this extreme. But as we got closer, clearly my awareness in the weeks leading up to the events in Great Britain and Europe at large, and how the impact it would have and ramifications for the financial world, certainly you could see it coming. But I had very specific information. I had a time point in this case for June 28th. In this case, it was a perfect, precise forecast. My next one, August 1st, was an actual top. Not of great as significant, but it was a perfect forecast nevertheless. It wasn't as big a move that was subsequently occurring, but we see it was a precise forecast, perfectly reliable. My next one, for the stock sector in the United States, September 19. So today we're talking in a few weeks from now. And subsequent to that, I've already projected October 3 all the way out to November 30th. And ironic, I don't know, that's curious. By the way, when I projected using an assortment of tools and coming up with Christmas Day, December 25, I then was, just out of general curiosity, looked at the calendar to see what day it was on. It's on a Sunday, so it's a holiday anyway, whether it's on a Sunday or not, but we're not open. So whenever you project a time point that happens, however you do so, using whatever procedures and methods you're privy to and you feel will be relevant, whenever you generate a date that happens to be on a day when the market's not trading, you necessarily look at the surrounding dates, so if it's a weekend or a holiday, etc. So this is my array of dates relevant to the stock market in the United States for the future. So hopefully that will be of some interest to you folks out there. And on that note, we're completing today's presentation. Let me just... if you have any questions, folks, now is a good time. Hopefully you've been able to hear. I'm not seeing any questions, so let me just see if there's any questions at all. If again, you can contact us. Peter Newman is the person that handles all of our internal affairs and can elaborate more fully on the programs that we provide. Myself and my coworkers, other mentors. Clearly, again, you have a webinar special. I'm not sure, but Peter Newman would be the person to handle the details and the contractual and enrollment agreements. Again, my area of specialty in my analysis is market timing, as this webinar has alluded to, but I do other things along with that. But hopefully you've got something out of it. Again, we have recorded today's presentation, so if you'd like to re-listen, you can contact Pacific Trading Academy at 800-339-8588, as well as access the website www.pacifictradingacademy.com. If you have more specific questions for me and or what in general some of the programs that we provide are about, then request Peter Newman. He is the contact liaison individual. So any questions? I have a minute or so left. I think I'm not able to, I just don't see anything coming up on my screen, so it might be, let's see, questions. Yeah. might be that it was such an because I went into some of the theoretical aspects, maybe there are no questions. It's not immediately, but I wanted to give you some insight as I have, I guess the last time I gave this was about almost 2 years ago. So rarely do I delve into the energetic componentry underneath the timing mechanisms. I know as a practical matter, most traders are most directly interested in what can we do. So various techniques for both market timing as well as price analysis that I do, certainly, that relates to pure trend analysis. I teach. I also, yeah, I'll leave it there. But any questions for the moment? If not, we'll wrap up today's presentation. Yeah, I just don't see anything. So I'll assume you are all up to speed, but if you have questions, you have the contact information again on your screen, and Peter Newman would be the person you request. Well, until next time, folks, I appreciate your attendance, and I hope you got something out of it, and I wish you a great day. And it has been recorded. Okay, so yeah, we have recorded it. Certainly, Rob, and you'd have to contact. I don't know if we automatically, our computer department, I don't know if they used to send out the recording to anyone who's subscribed to the webinar. I'm not sure what the policy is. They just contact me from time to time and say, would you like to do, or would you do a presentation on a different topic? So I submit a topic or a few topics for consideration. They set it up, and so I don't know if they automatically send it or not, or if you can request it, but I know it's available if you need it. Okay. Great. Someone's saying that they are similarly doing time analysis. Again, this is very specific. I focused on market timing, but having been in the business for 34 years. I started at Merrill Lynch as a securities rep, and out of kind of serendipitous, I did not know the difference between a trader at 24 years old and a stockbroker. So I started there, and shortly into my experience realized I wanted to be a trader, and kind of transitioned, and I befriended a guy in our research department who gave me a book on the magic of and importance of cycles. And that's and his basic lesson to me was initially, he was like, Glenn, you know, stocks and bonds and all the financial markets that we consider essentially are reflections of to a large extent of human activity, day-to-day activity. And that made sense. And he said, well, if you think about it, if you take it back a step, consider a 24-hour day. Much, 80, 70, 80% of what goes on in the course of any day anywhere on Earth is a function or a consequence of the Earth revolving on its axis. And it made perfect common sense to me. And he said, why would we, and if stocks are in turn, stock markets and financial markets reflect to a large extent human activity, and human activity to an extent is informed and receptive to the rotation of the Earth on its axis, that being a cycle, a very important starting cycle in and of itself. That was his argument as to why I should read this big book on cycles, and that I have never looked back since. So it can get it's a subcategory of the broader field of analysis that we utilize in stocks, but there's a whole myriad of other types of analyses. And again, as I said at the outset of today, what's critical to being successful in the field of speculation, as I see it, is not just the analysis, but combining your analytics with an appropriate set of rules and protocols covering money management, capital allocation, risk assessment, trade sizing, and last but not least, the importance that I place on ensuring that one's internal state, being objective, separating yourself from consequences, and so forth. But all three of these things constitute what I refer to as the kind of three-pronged approach to being successful in the field of, from a dollar and cent standpoint or metric of being successful as an investor in the markets. So folks, yeah, you can access, we have the tapes. I'm not sure if they send them. If not, you can contact the Academy and they can give you the instruction on how to acquire the recording. Until next, let's see, any other questions? I guess not. No. This again was a kind of a very specific topic. So until next time, I wish you a great day and profitable trading in the days and weeks to come. Talk to you soon. Bye-bye.